Hello, I'm Emily Costa, and this is the Commodities Institute podcast. Today is December 1st, 2025, and welcome to a focused, listener-friendly look at the commodity moves that matter right now. I'll take you through the headlines, break down the mechanics behind them, and give you the practical takeaways for markets, supply chains, and industrial users. Let's get into it. Start with metals, because that's where the drama has been loudest this fall. Chile's giant state-owned copper producer has been offering US clients copper at record premiums, more than $500 a metric ton above London Metal Exchange benchmarks. That's not a trivial spread. It reflects two simultaneous forces: a squeeze on refined copper availability, driven by mine and processing disruptions globally, and a short-sightedness in regional logistics that's forcing buyers to pay up to secure physical metal now, rather than wait for paper market corrections. Why does that matter? Copper is the lifeblood of electrification and construction. Think wiring, motors, transformers. When premiums spike like this, it signals tightness not necessarily visible in futures prices alone. It makes life tougher for fabricators and utilities who price contracts off LME or COMEX benchmarks. It also raises the odds that buyers will turn to regional sourcing and longer-term offtakes, accelerating supply chain shifts that could push investments into more mine capacity, recycling, or refined capacity expansions. For anyone with exposure to manufacturing margins, construction costs, or electric vehicle supply chains, this is the story to watch. Shifting to carbon and power, traders and major houses are quietly reshaping their portfolios toward gas. Big trading firms are looking at US upstream gas and LNG assets, not just oil, as a strategic pivot. Natural gas demand looks structurally firmer, with new data center power needs and a US liquefied natural gasity coming online. Meanwhile, Ukraine's winter needs are a stark reminder that geopolitical shocks can quickly change the flow of molecules and influence regional prices. Ukraine has been ramping imports via the Trans-Balkan route, almost doubling volumes to compensate for domestic outages caused by attacks. That's the practical downside of conflict: diversions in pipeline flows, emergency procurement costs, and tightened European balancing markets. For European utilities and traders, the lesson is simple: diversify routes and hedge the season. On agriculture, Australia is delivering a surprise in scale. Updated analyst surveys suggest the country is set to produce its third largest wheat crop on record, a record barley harvest, and a near-record canola crop. Those increases are driven by timely rains in southern growing regions and higher than expected yields in the west. The immediate market effect is downward pressure on benchmark prices. Chicago wheat has been hovering near its lowest levels since 2020, influenced in part by this abundant southern hemisphere flow. But there are nuances, pockets of downgraded quality. Some areas around Esperance could move 2 to 3 million tons into feed-grade classifications, and farmers holding on to grain in on-farm storage rather than selling into soft markets. That storage dynamic means physical flows to ports are slower, which can support local basis levels, even as global futures trend lower. For processors and exporters, the key takeaway is that plenty does not always equal uniform quality, and logistics and storage behaviour will shape the commercial outcomes into the Northern Hemisphere spring. Back to oil, where OPEC Plus held output steady for the first quarter of 2026, the group reaffirmed existing measures rather than pushing for aggressive market share gains, and it has more than 3 million barrels per day of cuts still technically in place, a mix of longer-term 2 million barrels per day reductions and episodic adjustments from a smaller subset of members. The messaging was clear: stability outweighs ambition. As market outlooks deteriorate, this ties directly into a newly agreed capacity assessment mechanism. From January through September of 2026, OPEC Plus will evaluate members' maximum production capacity to set fair baselines for quotas starting in 2027. That's an institutional attempt to depoliticize quotas, to base them on assessed technical capacity rather than historical claims or political bargaining. Expect contentious moments: sanctioned producers, capacity underperformers, and members who have expanded output will all have skin in this game. For crude markets, the mechanism could eventually reduce uncertainty, but only if assessments are perceived as impartial. The geopolitical overlay cannot be ignored. A recent naval drone attack on the Caspian Pipeline Consortium terminal at Novorossiysk has halted Kazakhstan's key exports and prompted diplomatic protests. The CPC handles oil from major Kazakh fields and represents a meaningful share of Kazakhstan's exports. With the SPM, the single-point mooring, declared inoperable and tankers pulled back, the region faces immediate logistical and financial disruption. If attacks persist or escalate, expect insurance costs, rerouting, and a potential reallocation of flows that will ripple through European and global crude logistics. Finally, a short note on dry freight and pulses. Canada's agricultural exporters face shifting tariffs and quota talks with India, which is exploring measures to ensure steady pulse supplies for domestic needs. Trade barriers, combined with China's duties earlier this year, are pressuring planting decisions in Canada, with farmers possibly switching crops in 2026. Dry freight rates will feel that on the backhaul balance if export volumes change meaningfully. So what should our listeners take away from today's mix? First, markets are being driven by a collision of physical tightness and political risk, not just paper market cycles. Copper premiums and the CPC disruption are physical stories with pricing consequences. Second, diversifying supply chains, whether in critical minerals, gas routes, or agricultural origins, is no longer optional, it's strategic. Third, expect policy and institutional shifts like the OPEC Plus capacity assessment and EU raw materials strategies to change investment flows over the medium term, creating both winners and losers. If you trade, think about where contracts are benchmarked and whether premiums or logistics could erode expected margins. If you make or use industrial products, monitor contracts tied to LME or COMEX and ask suppliers whether they face regional shortfalls. If you're an investor, these crises and shortages are signals of where capital will likely flow: processing capabilities, recycling infrastructure, and route diversification. That wraps up today's deep dive. If you found this episode valuable, be sure to subscribe, share, and leave a review. I'm Emily Costa, and this has been the Commodities Institute podcast.